afraid we're all going to have to prepare to pay a lot more for our homes and our car loans, as if it wasn't high enough already. Economists are expecting, as I mentioned, the Reserve Bank to increase these interest rates a little bit later this afternoon. It remains above the target of 3.5 to 6%. Well, let's unpack what that actually means with somebody much smarter than me, thank heavens, is economist Frank Blackmore, lead economist at KPMG. In fact, Frank, good to have you back on eNCA this morning. We'll unpack in a moment, if you don't mind, how we got here. But first of all, what could this mean for consumers? What sort of financial damage are we facing for cars and home loans, for example?
Yeah, so look, I think that's the most relevant, but in a way it's also the aim of what the Reserve Bank is trying to do. Remember, what they are targeting is the inflation rate, and we saw the latest read for August coming out at 7.6%, which is way above the 3 to 6% target range that you mentioned earlier. And what the bank is trying to do is make money more expensive, make borrowing more expensive, so that people, consumers, don't consume as much, but also businesses don't invest as much, and this cools the economy down, meaning that inflation then returns back to the inflationary band of between 3 and 6%. So although it will hurt, especially if you're a borrower, you'll have to pay more on your borrowing. That's the intention in a way of the Reserve Bank, to slow the economy and the activity in the economy down, so that we bring inflation down to a more manageable level.
A lot of people are saying that this has all got to do with what's been a bit of an inflation holiday because of COVID-19. I suppose if you work in marketing, you'll know there's no such thing as a free lunch. And I suppose we've got to pay the bill, don't we?
Yes, I think that's right. So remember what the governor said before the invasion of the Ukraine and the huge rises in petrol and food prices was basically we're going to have a normalization in rates. So what wasn't normal was 3.5% repo or 7% prime that we saw under COVID. And that was in a way to do exactly the reverse of what's happening now, to allow people to borrow more money, keep the economy going while times were tough. But we had to revert back to these sort of pre-COVID longer-term interest rates. And that's what we're seeing now, albeit at a forced pace. So I think we would have wanted to do that a lot more gradually over a longer period of time. But because of the increases in inflation, due to those fuel and food prices, we've had to move a lot quicker. And it's that speed and size of those changes that bring the pain.
As you talk about this gradual increase of interest rates, it was always going to happen, wasn't it, as well? So the reports, as I mentioned when we started talking, Frank, that we could hit the double digits. Is that your expectation?
Yes, I think by end of year, for sure, we'll be back to double digits. We came from a level of about 6.5% on the repo, which translates to 10% on the prime rate. But for now, we're currently sitting at 5.5% repo. And as you mentioned, the market thinks that it's most likely we'll get a 75 basis point increase. That increases us to 6.25% on the repo and about 9.75 on prime, which leaves a little more room for the November meeting if we needed to increase rates a little further. Otherwise, that would be carried over to next year if there's still some expectations of inflation at that point. But we have seen in the latest read a slight reduction in inflation. I don't think the bank is going to be happy with that. Until inflation returns to the band, we'll see more pressure from interest rates.
Yeah, and just very briefly in conclusion as well, because you mentioned the meeting later in November, and then obviously we have to look ahead to January 2023 as well, and I'm seeing 50 basis points and 25 basis points respectively for each of those. So does this seem on track with your expectations as I say goodbye?
Well, I think nobody's certain of what things will look like, and I think what will determine that is what happens in the data. By November, we'll still have to get September and possibly October's read before that meeting. If we have decent reductions, then, well, the chances for smaller rate hikes are better come January next year.
Hopefully from your mouth to God's ears. Frank Blackmore, thank you very much indeed. KPMG lead economist joining us this morning. So as good a news as possible as well, I suppose, is how the SARB is going to handle it later. My thanks to Frank joining us this morning. No doubts we'll hear from further experts and economists once we get the announcement a little bit later. But in the end, it's all going to come down to the fact that it's going to cost a bit more to do what we normally do with our houses and our cars. It really is starting to hurt at the moment, isn't it? Let's take a look at some other business news. And as far as the